So if inflation was going down with interest rates, that wouldn't necessarily benefit gold. The reason that gold is benefiting from these rate cuts, or the potential for rate cuts, is that inflation is going up. And so that guarantees that real rates are coming down, or in fact, real rates will be negative, which I think they will be. And that is one, that the price of gold is going up. So it's clear to me that the Fed is not concerned about inflation. Now, it can't admit that, so it has to pretend, but actions speak louder than words.
Gold surged to another record high, extending a weeks-long rally following Federal Reserve Chair Jerome Powell's indication that lowering interest rates could be imminent at some point this year. In his Wednesday speech at California's Stanford University, Powell acknowledged recent inflation figures, which, despite being higher than expected, did not significantly alter the overall economic outlook. He emphasized clearer signs of declining inflation before considering rate cuts. Renowned analyst Peter Schiff points out the market's negative reaction to Powell's remarks, particularly evident in the rising gold prices. While some observers might interpret gold's ascent during rate cut talks as normal, Peter contends that gold's true sensitivity lies in real interest rates rather than nominal ones. Therefore, if inflation were genuinely subsiding, rate cuts wouldn't necessarily propel gold prices upward. Nevertheless, the surge in gold prices amid discussions of potential rate cuts suggests that inflationary pressures are indeed mounting, leading to a decline in real interest rates and potentially turning them negative. Despite the Fed's preferred inflation measure easing from its four-decade high in mid-2022, recent reports revealed that consumer prices in February rose by 2.5% from a year earlier, surpassing the Fed's 2% target. Peter views this as a driving force behind gold's price hike and calls for the Fed to reassess its stance on rate cuts in light of this scenario. He suggests that the Fed's inclination towards rate cuts should be reevaluated, with the sharp surge in gold prices as a warning sign for policymakers to reconsider their strategies. Peter underscores the importance of the Fed keeping its intentions regarding rate cuts under wraps. The Fed could prevent further complications in managing inflationary pressures by avoiding public signals of such actions. This discreet approach would be crucial in navigating the delicate balance between economic stability and inflation control. We will present clips from Peter Schiff's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Because I want to continue about the first warning, which is that the inflation problem has not been solved. And the Fed is about to make it worse. You've got Powell out there saying we're going to cut rates, and gold is giving him a big raspberry, right? The big thumbs down, because gold prices are rising as a result. Now, some people think, well, it's okay, right? If because gold's going to go up when rates go down. But if inflation was really coming down, then it wouldn't matter if the Fed cuts rates, because gold is sensitive to real interest rates, not nominal interest rates. So if inflation was going down with interest rates, that wouldn't necessarily benefit gold. The reason that gold is benefiting from these rate cuts, or the potential for rate cuts, is that inflation is going up. And so that guarantees that real rates are coming down, or in fact, real rates will be negative, which I think they will be. And that is one reason that the price of gold is going up. And it should cause Jerome Powell and the rest of the Fed to say, you know what? We got to call off these rate cuts, because we've announced our intention to cut rates and gold just went way up. It's like you launched a trial balloon and the balloon, got shot down. It crashed and burned. Look at the gold price. So, that should cause the Fed to second guess and say, you know what? We're not cutting. The rate cuts are off. No cuts. Now, if they did that, maybe the price of gold would come back down. And that's what they should want, right? Because if gold is the canary in the coal mine, you want to keep that canary alive, right? You don't want that canary dead. And so the minute he's acted kind of sick, you got to go, hold up. I gotta change policy here. But they can't do that because the Fed's real agenda is not inflation. If the Fed really were concerned about inflation, especially given how it talks about the economy, right? The economy is great. The labor market is strong. Everything is great, yet we're going to start cutting rates. Why would you do that? That would be the last thing you would do. I mean, maybe if the economy was really weak and unemployment was really high, you might say, we're not really sure about inflation. We've got mixed signals, but, we got all these unemployed people. We're going to have to do something. We're going to have to cut rates. And if it means that inflation is a little higher, I guess that's a risk we're going to take. But if you're of the mindset that the economy is great, then why take that risk? Why start cutting rates? Why even tell the market that you're thinking about cutting rates when the mere expression of that thought is going to complicate your problem? Because by telling the markets to expect rate cuts, they're easing. That's an ease. That is causing commodity prices to rise, right? It's causing the gold price to rise. So it's making that goal even less attainable. So if the Fed was hoping that inflation was going to come down to 2%, by admitting that they thought that was going to happen and that they're going to cut rates, they now made it so much less likely that it actually will happen. It's you claim success, and that claim assures that you fail. So what Powell should do is keep his mouth shut and not tell anybody that he's thinking about cutting interest rates, even if he is, and don't let the markets know that. So it's clear to me that the Fed is not concerned about inflation. Now, it can't admit that, so it has to pretend, but actions speak louder than words.
In a recent address, Jerome Powell, the head of the Federal Reserve, dismissed concerns of an impending recession in the United States. He asserted that the current economic landscape is robust, with strong growth indicating no signs of imminent economic downturn. Powell's optimism about the economy's trajectory contrasts sharply with the views of renowned analyst Peter, who warns of the potential worsening of a recession if it materializes. Peter expresses concerns that a recession could be aggravated by rising long-term interest rates if it were to occur. Such a scenario would deprive consumers of the usual benefits associated with rate cuts, hindering the Federal Reserve's ability to lower mortgage rates effectively. This departure from past recessionary patterns, where rate cuts provided relief and stimulus to consumption, suggests a more challenging economic environment ahead. Let's get back to the interview.
What is that telling you, too? This is another warning. Because the Fed is going to be cutting rates. Okay, so why are yields rising? Because the bond market knows it's a mistake, too. Because bond investors realize that these rate cuts are inflationary, that the Fed is easing too soon, and rates are rising. This is going to complicate what the Fed is hoping to achieve by its rate cuts. Because if the Fed lowers short-term rates, but long-term rates rise in the face of that, and the yield curve steepens, that is going to create a lot of problems. The mortgage market is not set by the Fed funds rate. It's more tied to the 10-year to the 30-year U.S. Treasury. So if those yields are rising, even as the Fed is talking about cutting or does, in fact, cut short-term rates, that is a big problem. But also, I think if the economy goes into recession, because again, or if it goes to the point where we officially admit that we're in a recession, rising long-term interest rates are going to complicate that recession because the consumer is not going to get the benefit that he's used to. When the economy turns down, you get the rate cuts. And you can refinance your mortgage. No one's going to be refinancing their mortgage in the next recession because the Fed is not going to be able to lower mortgage rates because of how high inflation is going to be. Gold is telling you right now that this is not going to be like 2020 or 2008 or any of these previous recessions where the Fed was able to provide this relief in the form of lower rates that helped, reduce people's debt service burdens, provided a stimulus. That's not going to happen. In fact, there's going to be a sedative. rising rates and rising prices, which are just getting started. I mentioned the commodity price, the CRB index, and how much it's up. But what's more scary, look at a chart. In fact, I'm going to tweet it out again. I put it up there like a week ago or two. But now, I mean, we keep moving up, but we're just under the high from 2022. But we're about to take that high out. We'll probably take it out this week. But look at that chart. That chart looks like it's about to explode. I think the next stop is the 2011 high. That's about 15% from here. But I don't think that's going to be much resistance. I think we got a shot this year, and if not this year, by next year, of making an all-time record high in the CRB. That was set in 2008. And the only thing that brought it down was the 2008 financial crisis. But prior to that, the CRB was rising because the dollar was getting killed. In 2008, the dollar hit an all-time record low. We're nowhere near an all-time record low now. But I think we're going to get back up to that 2008, maybe this year. But if we got there this year, that would be a 50% increase in commodity prices in 2024, a year where the Fed is talking about having inflation coming close to 2%, much lower than it was last year when commodity prices were flat. I mean, nothing that is going on in the commodity market is consistent with the view that inflation is coming down.
While none of these experts expect gold prices to fall anytime soon, because the overall upward trend in the price of gold is gaining strength, its current gains have been sufficient to push all technical indicators towards intense buying saturation levels. If the current factors driving its gains persist, including the weakness of the US dollar, increased global geopolitical tensions, and heightened purchases of gold by global central banks, reaching the next record high of $2,300 per ounce appears increasingly likely. Share your thoughts on Peter's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.